Hello and welcome to Moving Iron Podcast. I got Rich Posson back here to talk about what's going on in the world of the economy and brand new year here, Rich. Start over again, 2025. How you doing, man?
Good, and you?
Not too bad. You have a good holiday season, good New Year, and all that stuff.
Did.
Good,
Yep.
good. Are you spared from the feet of snow, or are you just in the inches of snow?
It's been light snow. We've
Is
had
it?
times I had to get out the tractor and bucket and plow and this and
Yeah.
that, but it could be much worse compared to what I was away from upstate New York for 16, 20 years, something like that. And I come back and I thought, wow, this is so much different. Yes, I'm a
Yeah.
believer in climate change because when I was a kid, you could have 6 feet of snow and 40 below zero, and it was great snowmobiling. But I
Right.
mean, today you can't even really snowmobile around here.
Yeah.
So big
Yeah.
change.
Yep. Things are definitely, even around here, it's so hit and miss where I'm at, where we'll have an incredibly bad winter, and then we'll have a couple, like these last couple winters for us have been pretty mild, all things considered, comparatively. So, but I think we're due here for a later colder winter, I think, than normal. So we'll see what happens there.
Yeah.
See what happens there. All right, Rich, let's talk a little bit about what's going on here. We are what? Let's see, what's today? The 10th. So we've got about 16 days till Inauguration Day. We're going to see a new policy come into play with the Trump administration, comparatively to what you've seen out there. The stock market has seen pretty good runs. We've seen some decent times here late, but we're starting to see some volatility creep in. So I guess your thoughts on the stock market, bond market, and those kind of things.
Yeah, so I've made a significant change here. Some of it is on the policies and where we're going. I mean, this country could change many different things. It's not like other presidents where they had, here's my list. On the right wing side, we have many lists, okay? And it is interesting. The modeling for the stock market is nervous, or making me nervous, going into, say, spring, summer months. And I was watching what was going on with Congress, and Trump would like to pull many bills together and make one big bill. And they were saying we might not have that wrapped up to April or a little later. And I thought, well, gee whiz, that's kind of coinciding with the model saying we may have to wonder what's really going on here for a while. At the same time, though, every president, when they come in, they like to sign some bills right away, get going as fast as possible. So I'm sure with the inauguration, where we're going to see some action there, there's going to be some fireworks. And you can make, like any change in our country like this on the political side, there's positive and negatives for everyone, no matter what. What the modeling is doing is basically saying we've had 2 good years, over 20% a year, 2 consecutive years. For at least Biden, he can say, hey, that was one of the best runs in practically any president going back many decades. However, I look at it as a presidential term, and I do a little bit different. I use the January close price to compare for the prior 4 years and label that as that president. And actually, Biden's been running a little light on profits from the stock market. It's just those 2 years, those final 2 years, though, big bang, big push. Well, if you look at the history of the stock market, if you get 2 consecutive years, you better start thinking you can have a go nowhere year before going higher. And that may mean only a few months pulling back. So in December, I was coming up with what's called a minor long-term top or sell signal. It occurs about 4, 5, 6 times a decade. It can lead to a -7 to -36% decline in the stock market. I don't think it's going to drop on the severe side. I think it's going to be rather minor. But I told myself in December, the model is saying this ought to be the latest allowed. This should be over and done. We've stretched the rubber band. It should have topped a long time ago. We've had a good run. And I said, you know what? I really should stay somewhat invested for the bigger move this decade. I'm still optimistic and bullish, regardless of what Trump does. I think we're going to see some good things out of it. We'll see some bad things, but I think the stock market's going to move forward. The economy is still going to move forward. People got to work, they got to eat, and they will invest. But I couldn't help myself. In December, I got totally out of the stock market. So I'm 100% cash, and I got out near the high of the year, or high of December. So I'm looking fairly smart right now for this size of a decline we've seen. I think it's been 4, 5, 6%. And we may see additional decline this year. I think even if I'm wrong on this long-term setback, it could still drop -7 to -11% at least once this year. And really, once a year doing that is kind of normal when you look at the history. So I said, let's take a chance. Like at first, I just wanted to sell some and try to buy back cheaper, but don't sell everything, so I don't feel bad if it just keeps on going up. But I'm taking a chance of being more aggressive here, and I'm out. I even bet on the downside a little bit for my family's hedge fund that I run, and made a little money on the downside here, and I'm out of that. And I will be shopping in coming weeks for a bottom, and I think probably the market will be higher going into spring, summer. But you can just see there's a lot of issues that we're going to shift gears in this country. There's going to be some big change, and it'll be good for some people, bad for others. It's as simple as that. Okay, it's no way of making it good for everyone, and it may be a price we have to pay before going on to much better times. So then, if I throw out all this political stuff that's going to lead to policy changes, that's going to lead to impacting economy, stock market, somewhere. If I throw that all out, we'd probably be coming down anyways, just from how normal business works. And we're seeing some economic indicators that are getting sluggish. They have a few issues here, and there's others that look really good. So it's a mixed picture, and it just made me concerned. Yeah, the model's probably right. The stock market might not like that mixed picture. It assumes, what if things get worse? So put out a sell signal, and I'm a little more aggressive than I thought I would have been over the past couple of years preparing for it. I don't want people to think I'm panicking here. It may not be all that serious. So what I'm using as a guideline, if we get new record highs at certain times during the year, it probably means it'll be higher in 2026, and that'll make me a little more relieved. But we still got to look over our shoulder for maybe a -7, -11% down move, which would just be normal business. You either write it out or you make some adjustments there. You hedge it just like a grain farmer would hedge his grain from lower price. You can hedge your stock market. You can buy insurance. You either deal with it or you don't. You just write it out. And again, I don't see it as an end of world scenario. It's just that it's time that something can go wrong and set the stock market back a little bit. And we'll take it one step at a time. But I made the signal, and then as a backup, in case it doesn't go down as low as I think, doesn't stay down as long as I think, and it may stay down all the way to October. I kind of doubt it, but the model's saying that's how long it could take. And but again, if we can get some record highs, then I'd feel a little more optimistic. And so I'm also saying it might not be quite as profitable a year as we thought. I think that makes 2026 even more profitable, frankly. And so we'll take it from there. The signal's been made, and we have a backup of telling us when to turn around if we're not genius enough to actually buy a nice lower price. That's what I'm after. I'd like to buy a setback and get back on board.
Right on. Okay, so you've talked about the stock market. Now you take a look at where the Fed's been at on interest rates. They've dropped interest rates two times, 3 times, something like that during 2024. But it felt like every time they did it, it was with complete and utter reluctance, right? Like it was just like, we don't really want to do this. But we feel like we can, I don't. It's kind of like me going out and running in the morning. Like, I really don't want to go run, but I probably should, type of thing. Yep. And there was always some kind of reluctance in their voice when they were talking about it, because you could hear, Powell talk about, everything's kind of pointing to this, but we're still seeing some heat on the interest rate side. We're still seeing on the inflation side of things. I guess, Rich, as you look at inflation right now, what are your models telling you? And do you feel like the Fed has made the right choices with this last interest rate cut, or do you feel like they should have went maybe deeper, or do you feel like there's another cut coming here maybe in this first quarter of 2025?
Yeah, I think they probably made the right decision to cut. What they're looking at is the same thing I'm looking at, my model's looking at. There's some portions of our economy that have been slipping. I think some of it was businesses reluctant to go out there and hire more and expand more. Starting about July, they were preparing for the election to see who won, get a better handle on what they're doing. I think they would have done that no matter what election, okay? I think it's normal behavior. Now the key is after election, what have they done? What are they doing? And we don't have enough data yet. It's taking a little bit of time, but I think they're a little bit reluctant still, that they want to see what policies are really doing. How's that going to impact business? But I think they feel a little better. And some of the polling is showing that even the country, even though it's divided, they are swinging in the direction, both sides saying, well, let's give this a chance. Let's see where we go with it. So, but that impacted business, that kind of attitude of let's wait and see a little bit. And it's slowing some of these indicators down. Well, the point is, if it was just election driven, I would think they would rebound. All right. They would go back to hiring, expanding, and doing more. But if it is evolving towards policies they don't like, worries over the trade war, worries over inflation, then we may not get that expansion back the way we should, or not fast enough. Now that can ripple through and cause some problems. The Federal Reserve's thinking that's the same stuff. I mean, they're looking at the same things, and they see some of these indicators, some of these pockets within our economy that's actually slipping and eroding. And even though the economy is actually very good, I mean, Biden is handing Trump a great economy. Well, good economy. That's no longer great, in my opinion, but it's good. Okay. We do see some of that slippage. And so I think the Federal Reserve realized that they kept interest rates a little bit too high, too long. And they said, we're going to get caught up somewhat. And there's even the Taylor rule that was invented by Mr. Taylor, who used to be at the Federal Reserve. Now he's a big time speculator, money manager, I think. And the Taylor rule is saying way back in summer that the Federal Reserve ought to be at 4%, not 5%. And I think the Federal Reserve knew that. And I think they just said, we got a little bit of a gift here to catch up. And we're seeing it as some information that we can say, hey, this is why we're doing this, to be safe. Let's provide a cushion here to make sure these indicators aren't deteriorating further, or we're adding more slippage, more sectors of economy, because the economy doesn't normally crash and burn overnight. It's normally a process building into it. And then suddenly we wake up, wow, we're in a recession. So the point is, there's detecting that we're heading on a path that could become a recession. So they're saying this would just be normal for them to lower their interest rates. So they did it. But you're right on the idea of being reluctant, because they're also thinking, you know what, there's still not enough evidence to say we truly killed this inflation thing. There's nothing to worry about for years to come. And then they're looking at the potential tariffs by Trump and a few other things that can relate to that, make it better, worse, whatever. And they're just saying, if we're not careful, we could be lowering interest rates just as the time interest rates jump or inflation jumps. Then we've got to raise interest rates again. Okay. So they're caught in a tricky situation. Now, my personal inflation stuff a few months ago, or towards the end of the year, basically said we need to anticipate an increase in inflation, but it shouldn't be all that big a deal. It would have happened under anyone, Harris, Biden, Trump, no matter who's there. It was just would be normal business. I'm sticking with that. I do think we can see a little firmer inflation now in the next 2 or 3 years. I think it comes and goes. All right. The model is saying, yep, that ought to be a done deal. That's how it should work. Okay. But it should be a modest uptick. So the Federal Reserve probably looking at that as well, saying, okay, we can live with that. And the way Powell spoke in the past 3 months here, you could tell he was saying we probably can live with that. Yes. And he even said we're actually forecasting a rise in inflation. So I think I'm on the same page with them. I think we're doing the right thing. The problem is with the tariffs, there's a lot of information out there suggesting it can make inflation surge. And there are people who are still betting that we're like in the 1970s, when inflation soared in the first half of the decade, came down in the middle part of the decade, then soared again in the latter part of the decade. And then that gave us an average for the entire decade that was higher than the prior 3 or 4, 5, 6 decades. It was a high inflation time. People did not like it. Okay. And it's interesting. I just redid all my research here over the weekend and found that, gosh, we are vulnerable. That can happen just as well. So I can see a little up move in inflation, and I can see a surge in inflation. It's almost 50-50, flip the coin, pick what you want. And it just depends, where are we going with this country? Because we're going to take it in a new direction one way or the other. I mean, it's here. All right, we're going to try it. So now the question is, what's going to be the pushback? And even though I've been in the camp, we ought to be scared of tariffs, actually, I will say I find periods of history that the tariffs worked for about 2 to 3 years. The country generally liked it, made money, middle class was happier. Then it didn't work. And that's about all it did, okay? And I just read an article here a few days ago. It was on Foreign Affairs magazine. Someone wrote an article. It wasn't in great details, didn't give me a lot of economic science stuff, but it just showed the history. And what they were saying is that if you compare us today, we're nothing like the 1920s, 1930s, when they raised tariffs and it actually helped cause that terrible depression. Herbert Hoover had a great run. He was warned by like 1,000 economists, do not sign that bill, Smoot-Hawley bill. I may have got the name wrong. Do not sign that for those tariffs because it's going to be a problem. He signed it and boom, the whole country crashed. I'm not quite as negative on Hoover as some are. I think there was a lot more to it. We had way too much personal debt. We had way too much debt in the stock market. There was a lot of other problems there, but the tariffs, you have to blame the tariffs partially, at least, that it caused the problem. But this person who wrote the article pointed out, we got such a different economy right now that we may learn these tariffs actually help us. So I'm willing to be a little optimistic here, open-minded toward it, because I do think the whole world wants to readjust to have fair trade for everyone, all right? Now, Trump's going to be more aggressive than others because I think what's going on is we have globalization from 1980s all the way into basically even the late 2010s. And it started out a good thing. And the U.S. did its best to make sure it was the winner of that, would win more than any other country in the world. And so it was trying to control that, even though it was saying it's free trade. And it worked. But eventually, China, we sent too many jobs to China. So did the rest of the world. And China started winning, okay, and winning very, very well. And the rest of the world started to go downhill. So we all got upset. We all got mad. And Trump, I'll hand it to him. He'd come in there and he was the first one to step up and say, we're going to change this now. And we started the trade wars and the tariffs. And yes, it's not the best way of doing it, but I don't know as we really had much of a choice at that time. We had to try something. And the whole world followed us, okay? And even Biden has followed Trump. He actually even added more tariffs. So we know we're working on deglobalization. Now, here's the key. The key is the U.S., Congress, the American people, business especially, they want to make sure, just like during globalization, we were the winners, the leaders, we want to win and lead again. And Trump's attitude is more mercantilism, of letting business own and run the government. That's number one. Nobody else matters. Nothing else matters. And he's doing that as an effort to make sure we're the winners on this deglobalization. What it could be, though, is going too far, too much of an extreme. If you study mercantilism in the 1500s, 1600s, 1700s, boy, it got kind of ugly for some people. They were making countries work for them like they were slaves. They had issues of taking over countries. They had issues of business forcing the government to take the military and go fight a war for the sake of saving their business over in that other country, So there's a big negative side. So I am concerned how far we go with this, but I understand it right now that this is our opportunity to say we just want to protect ourselves and make sure we can make a buck out of this. And we're going to try our best to be the leaders of that. And so that's, but again, all of that might become inflationary. And the stock market is not going to like it. And if the Federal Reserve is not held back by Trump, they're going to raise interest rates. And they'll raise them high enough to eventually kill that inflation. So it may only be a 2 to 3 year surge of inflation, but for you and I, it could be a very volatile moment of everything's going up in the store once again, okay? And even though we might enjoy making some money out of commodities, it could be a straight up, straight down move as we wind up hurting demand in the end. And could even send the country into a recession. So as it turns out, I have learned from 1980 back to the 1800s, early 1800s, you could expect my once a decade sell signal and recession that I'm forecasting still for 2028, 2031, but you could get a secondary recession about mid-decade. It occurred almost all the time in the 1800s to early 1900s, but even up to 1980. And I think we're kind of switching back to the days of 1940s, 1950s, where all these wars and the politics and this and that, which eventually turned into be a pretty good thing, but you still had that secondary recession. And so this is nothing that bothers me. I can see a great time in the next 2 or 3 years, but yet I can see a recession as well. Okay.
Right.
And so we got to watch out for that. All right. Yes, I'm leaving the door open for a surge of inflation. I'm hopeful it doesn't come. It doesn't necessarily have to. Again, we just got to see, we got to get Trump in there, get some bills signed, take action, and see what's it going to do. Is it going to break something, or is it going to help something, or are we going to break something and then it works very nicely for us? Lots of questions to be answered. I recently wrote an article for a private group of analysts, and many of them have said the same thing, really. And that is, if we had someone other than Trump, we'd probably have 5 to 10 things to calculate of where are we going, how's this going to work. Under Trump, we got about 20 to 30, 50 things to do. And yet it can still all be fine. I mean, I'm still optimistic and can be very optimistic at some point. We just got to watch out for some of these twists and turns along the way here that might upset the economy before maybe it gets better, and might upset inflation. So I got a dilemma that the highest inflation this decade, if it's what I call once a decade top, we're only going to see a little bit of an increase in inflation in the next few years, and it shouldn't be that big a deal. We'll manage it. We'll go on. Life will be happy-dappy. But you can see if it wasn't that once a decade top, then it's actually due in the next few years, and that paints a picture much like that pattern of 1970s of extreme inflation, and it's there. So, and again, most people are linking it towards tariffs. I'm a little more encouraged with some of these other economists digging in a little bit deeper and saying, no, it doesn't have to be bad. All right. So, and so I'm hopeful that's the way it's going. But, at the same time, there's no evidence we should throw out the idea tariffs can come back and shoot us in the foot here. Something else is going to be different this time around. Compared to the history time. I mean, I love to study history to tell us where we're going for the future. It works, but you get into some surprises sometimes. And I will say this time our economy is different than the 1920s, 1930s relative to tariffs and relative to a crash or depression. But at the same time, it's different globally in the sense these countries can react to us faster than ever. All right. And China's already sanctioned another 20 countries. They're building a bigger list of where they're pushing back on us, saying we're not going to allow you to do so much business with these companies in our country. Mexico's already saying, you want a war? We'll go to war. Canada's saying, you want a war? Germany's saying, you want to go to war? We'll go to war. So, so this is going to be an interesting time. And that kind of encouraged me to get out of the stock market more than I would. And I think I'm going to be more flexible, do a little more buying and selling this year on in the next few years than what I normally would. But at the same time, the model is saying we can still have a good growing economy no matter what, and the stock market can go up no matter what. Stock market is pretty good at ignoring a lot of what's going on in the country. It can be rather narrow-minded. And I will say right today with the AI boom and where we are for the economy, even though it's eased back, not as quite as a good ending here for Biden as it was a few months ago. It's still a good economy. And I can see where it may remain a good economy right into 2026 before anything bad comes from all this tariff and other things. But I just got to be mindful and watchful all year long and take it one step at a time. I mean, you always have to take it one step at a time. But what I'm saying is the last 2 years, I might sell 20% of my stock portfolio a few times a year, and I'm setting on 80 or at least 60% of it. Just write it out to make sure I have something in there in case it just kept going up, and it worked quite nicely. But now I'm thinking, well, I might want to, or I should say that's what I was doing until the last 2 years. Then I started wanting to keep more and more in. Now I'm swinging back. I'll take a little more off and be a little more flexible with it. Yeah. And so that brings us a question of interest rates. You mentioned interest rates relative to inflation. The interest rate trend has been up since summer. The bond market has been betting all along that, boy, if Trump wins, then if we do the tariffs, then then we're probably going to have higher inflation and higher interest rates. So it's been playing the game ahead of the stock market. Stock market's been kind of ignoring it. It's saying, we'll get along. Whatever Trump does, he'll be fine. Don't worry about it. The bond market's saying, no, we ought to think about this a little bit. And then it's not only that. It's not just the political policy side. The bond market has been telling us, boy, we're printing more and more debt here, government-wise, private-wise. How much of this can we market? How can we swallow it? It takes, we're going to have to raise interest rates to entice people to buy this debt. So there is a normal business stuff of debt going on here that's raising interest rates, but some of it also is all those what ifs under Trump this time around. Okay. Mm-hmm. And to me, my model's saying, hopefully we'll get some relief in interest rates by March and hopefully see a better stock market by March. But from now, maybe into February, we can still see some higher interest rates. Keep in mind, late this month, we'll have the Federal Reserve out. And then we're also going to have the 2 monthly normal inflation reports and jobs reports to compare with that and try to get a guess of what is inflation doing and what would the Federal Reserve do here. But it's been a nice run in interest rates, and I've been very pleased the stock market has been spot on with it. And it even said we better expect a little more higher than this too. Dollar index looks exactly like the interest rate run. All right. And at times even stronger, like it's leading interest rates higher. The dollar, by the way, has bothered wheat a little bit, but the corn and soybeans don't seem to be paying much attention to it. And so far, the dollar hasn't hurt the economy, but I do believe the stock market and economy would prefer a lower dollar, and we might have a higher dollar into summer that could give us some problems here.
All right, so I got a question for you then, kind of based around what you talked about there. You can't really trust any news that comes out of China, right? Because one day it's the best corn crop ever, and the next day it's, we cut it in half. And then, so you're talking about that. But as you look at what they've done with their economy, they're going through some very, very large quantitative easing, right? I mean, they're really dumping lots and lots and lots of capital back into their economy, which it just feels like it's not getting any traction from what you read, right? So I guess as you look at this, Rich, what's that mean? Okay, so the strength of the dollar is really strong right now, so that's not really, China's gone back and forth with the dollar thing for a while, but it just feels like China's rebound out of COVID just never has happened and never has taken place, and they just can't seem to get a foothold. That's it's like 2 steps forward, 1 step forward, 2 steps back every time they go do something. So I guess as you're looking at China's economy, how do you think that plays into what you see as far as the world economy goes, and the pressures that maybe you're seeing in some of these other factors, or maybe some of this pressure from China a little bit?
Yeah. For the moment, I don't see a contagion there out of China for the rest of the world. I mean, it might be limiting how well we're all doing, but because we're in this deglobalization anyways, where we were looking to do business with other countries, so we've kind of swapped it out a little bit, and that's kind of helped provide us a cushion. For China, the issue is, they kind of beat us in the old globalization stuff by tying to our currency. But with our stronger dollar, it actually makes it a little more difficult for them around the world. They're kind of like the world's saying, basically dollar-wise, we either buy from U.S. or China or both, So It's like, if anything, if some of those other countries can actually compete manufacturing China and U.S., they actually got a better opportunity to sell to other countries, And or even sell to China, U.S. better. So I think what we have is that could be hurting and partially explaining why they got an issue, because they really are being clipped by tying to the U.S. dollar, being clipped around the rest of the world of where can they sell. I don't think that's a big problem, but it's there. It's present. The big problem was they took so long pulling out of COVID, which you can't blame them. You've got 1 billion people to worry about and worry about spreading, but they did take too long of pulling out. I think it really disappointed the people, and it's taken a long time for the people to really feel optimistic about where their future are. Their stock market hasn't done anything for a long time. And then the real estate blowout really has really upset the people, the younger generations. They don't have the best employment right now compared to what they had. And so just a lot of lingering issues there. I'm telling myself I have friends saying, you better watch out. China's going to bring down the whole world someday. And so they're always asking me what I have, what can I show? And I'm still coming up with ideas that I don't think we're going to see a real crashing moment just the next few years in China. I think if it has, it's going to somehow coincide with the US and the rest of the world for my 2028 to 2031 idea. But it is something I'm watching. I'm wondering, can China blow up and then create that big sell signal, that once a decade sell signal, create it for me, for the U.S., that the U.S. is now going to be into bigger problems? And but I will say, I would tend to think maybe this trade war stuff should make China a little more sensitive than us even of what might go wrong.
Mm-hmm.
So definitely watching China. I'm just not coming up with the evidence that it's going to fall apart. They're kind of stable, and I think they can improve the next couple of years, but I'm also not optimistic of a big improvement. All right. And I think they've been fearful to print a lot of money and boost the economy because it's just afraid that it helps short term and maybe creates a different problem, negative problem long term. And I think they feel like they're actually smarter than the rest of the world are doing that right now because they're doing their best to study the history of capitalism and money and printing and this and that. But at the same time, I sense over the last 60 days, I mean, they've actually done a little more money printing. They might be getting restless there, that they're kind of thinking maybe they have to push it even harder, and see if they can boost that economy a bit more. And but again, I wonder how all this global trade stuff will do. I wonder it can hurt China and hurt the U.S. all at the same time.
Yep. You still think the old adage? I'm just one of those the old. My grandparents used to say this all the time that when it came to the economy that the United States would get a cough and the rest of the world would get pneumonia, and it would. Do you still feel that way? Do you still feel that?
I do. My guess is, if it hadn't been for this deglobalization stuff right now, my guess would have been eventually China's the one that does that,
Right.
And it may yet come in the next 20 or 30 years. I'm just not convinced it comes this decade. Yeah, I think the China or U.S. is still that's how it works. That we're still the biggest gorilla, even though in the room, even though there's still there's issues there when you can see China is like the second gorilla now though. Okay.
Right.
And so the whole trade war, tariffs is number one of my top of list of what might go right or wrong. I mean, I don't particularly care for this attitude of let's really crush and burn the government, but I got a feeling you will, people are going to lose jobs over it. They're going to do this and that, and it could even cause a debt crisis in this country, I suppose. But right at the moment, I think that's further down the list for me personally, that we could survive that. And that could be a better thing later, that we wind up lowering taxes, we wind up lowering debt, that we could squeeze through. And so to me, it still leaves probably this whole trade and tariffs thing and global relations as number one. So.
Yep. Okay. All right, Rich, one last thing to hit on this real quick. We've bounced around and danced around here a little bit. Just talk about where you think the dollar's headed as we look into the first half of the year in 2025. Obviously, dollar strength has a big footprint on what we see happening with commodity prices and how exports and those kind of things will work. But this might be one of those years where we could have a strong dollar and strong exports just because of the pressure we're seeing in Brazil right now when it comes to weather related issues with crops. And then we still have to plant our crop here in the United States yet. But as you're looking at that, what's your feel for the strength of the dollar, and how do you think that impacts global trade?
Yeah, I think the dollar will probably go higher in the next 2 to 4 weeks. Then I think it's going to set back. I think by March we'll say, okay, we've pulled it back some. Now, that will be very interesting to see. If we can pull it back a huge amount, then there's a chance that it probably will rebound slightly, at least into summer, but it probably won't be a big deal. And the latter half of this year, I'm hopeful we see an easing back of the dollar and we're doing okay. But my concern is that the model is now showing up. As I said months ago, probably the dollar could be stronger into late 2024, then down, but I knew there was a chance of being higher into early 2025. Well, the model is warning that if they don't pull it down much at all, and say by March, and then it starts moving up April, May, then we've got an issue that that doesn't give us enough cushion that the dollar can be at a new high for the year, say April, May, June, July. And I'm just nervous that's getting a little too high and can cause some problems export-wise, economy, interest rates, inflation, all that fun stuff. So hopefully we're just about done with a dollar run-up. We're going to get some relief. And if I'm wrong in that, hopefully we just don't get it much higher than what we've seen going into mid-year. Fairly confident it'll be backing off later in the year, and I think we'll need it by that time to help out. So yeah, higher next 2 to 4 weeks. And when I say the dollar, I'm using dollar index. I don't study individual currencies like I used to, and so there may be something different for some of currencies, but I'm pretty confident higher in the next 2 to 4 weeks. Back it off for March, and so that's how I would look at what's going on for the first quarter.
Right on. Last thing, I know you track this, and you keep pretty good score of this. Any of your models talking about any weather issues you see coming up here as we head into planting season?
Yeah, but I kind of feel like I'm stuck on a treadmill here where I'll keep looking for a great problem. One of my models last year was the last year for it, didn't happen. And the model's revised and saying, oh, we had a smaller issue prior years and it's going to retime and all that. It's calling for a lesser important problem now into 2027. Normally, I wouldn't make a big deal of it. But there's another model saying it might be far more important that we still have the Gleisberg cycle like some people have been talking about.
Right.
That's still there. And I remind myself in 1988, even though I traded that very well, I was still farming, and I made a big bet, spent my dad's money, bought a huge amount of soy meal, like 2 or 3 years worth of soy meal, and loaded up on futures on my own account and this and that. So it panned out very, very well for me. I had people knocking on my door, can you sell me some soy meal? And so we really cleaned up. My dad gave me a 2-week vacation in Barbados. Okay. The alternative would have been I've been fired if it hadn't gone the other way. But at any rate.
You had a permanent vacation then, right?
Yeah. It was a good time, and had a Porsche car, drive around. For a farm boy, I was living pretty good. All right. Mm-hmm. But the thing was, in 1988, looking back at it, now that I know as much as I've learned over 40 years here, that was really supposed to be not that important of a crop problem. It's kind of like what's due right now, 25, 26, 27, not so important. Yet we got a gigantic thing. Well, what it turned out was some different climate cycles that really don't fit in my kind of modeling. And that could be this Gleisberg. So I'm telling myself, even though my model is saying we ought to have a modest setback in yield and production and a modest up move in prices sometime here soon, you can just see that Gleisberg could really make things very, very interesting. All right. But I'm at the same time, I kind of feel like I want to be cautious of making people very, very bullish, because at least on the farmer side, you got to take care of business on the way up. Don't try to be the genius to hold out and sell that, because it can go up for 2 months and go down for 3 years. So
right.
do keep that in mind. But it does, we're set up where we do have to consider even this year some kind of problem. And my gut feeling is we're going to back yields off a little bit this year, and it's actually going to be next year is going to be the problem. But I don't want to disappoint anybody that loves that kind of bull stuff and they think we got a big problem coming this year. Hey, I see what they're saying. I just don't think it's going to be that big of a thing right now.
Right on. Rich, good stuff as usual, man. You threw a lot of stuff out there for people to think about. If folks want to reach out to you and get more information about what you're doing, what's the easiest way to do that?
Yeah, you can go to criticalpointpod.com. That's my website. You can also go to criticalpoint.podbean.com. And right at the moment, we've got everything up for free for a little while here. Mm-hmm. I'm redesigning a website. I'm coming up with a couple of new subscriptions, splitting up some of the markets in different groups and offering a little lower price for that. So for the moment, based on putting everything up for free. I don't know how long that'll be. It might only be a few days, few weeks probably. But it's there for them to take a look at of what these weekly updates are doing, what's the morning briefs, if they want something every day, that's there. I just tell people if it looks like there's too much information coming at you, just make sure you check in on the weekly update. And then look for anything that says alert in the grains or the stock market, and check on that. They can also email me at rich@ag-financial.com, and I'm still on that X Twitter thingy there of Rich _ Posson.
Right on.
And I am also on Threads and Blue Sky, but I keep forgetting the addresses. They're similar to the Rich _ Posson. I think they can do a search and find me.
Yeah, I got to get on that Threads and the Blue Sky thing. It's a new and upcomer. You got to stay on top of them, Rich. They're always popping up there. Rich, check out Rich's podcast, Critical Point podcast. Got a lot of good stuff on there. There is a free version of that he puts out, and there's some quick hitters on there. They're 5 to 7 minute long little quick hitters about whatever is going on that Rich thinks is the most important thing right now. And then he also he talked about the subscription side of that. Give that website out one more time, Rich.
That would be criticalpoint.podbean.com. That'll take you directly to those videos, audios.
Yeah, so check that out. A lot of good information there. Rich, appreciate you being the podcast, man. We'll talk to you again here hopefully next month.
Thank you very much.
Right on. I'm Casey Seymour with Moving Iron Podcast. I got to redo this now because I don't know what I'm supposed to say now because Farm Journal owns this podcast now. So let me think about this for a minute. Let's say, let's see here. All right, Rich, appreciate you being the podcast. We'll catch you again next time. So with that, I'm Casey Seymour with Rich Posson. Let's go move some iron, folks. Out.